Hello, everyone, and welcome to our episode 3 of the Harmonic Patterns Mentorship. So, um, this particular episode, uh, first of all, what is on my screen is Wyckoff. Okay, this is not Harmonic Patterns. I was on the chart. I made this analysis and I made it to the public about 2 days ago. I think it's also available on YouTube. And market is still within this range. But this is Wyckoff. Okay, this is Wyckoff. This is a Wyckoff distribution schematic. And I'm expecting a schematic 2 to play out. If this was a schematic 1, we would have price to clear out this high, which might be possible, since this would be a weak high compared to this structure. But today we're going to be discussing about harmonic patterns, and we are not yet officially on the chart. So I just decided to start off like this, so I'll show you guys that yes, I do understand multiple methods, and it's not a conflict to me having to scale through each of them whenever I'm on the chart, or having to use whichever I want to when I'm looking at price action. Okay, so when you say you're learning harmonic patterns, smart money concepts, ICT, that's not a problem. Okay, all these are very useful tools when it comes to analyzing. So you knowing them is not a problem. You don't have to stick to just ICT just because you think that that's the right thing. One thing you need to be aware of is that the market is constantly moving. So the algorithm is always getting updated, and systems do get outdated. But at the same time, systems that have stand the test of time, I think you should try and, blend with. I'm not saying you should stick to just them. I'm saying that whichever method you have been learning along the way, throughout your entire journey, you should try and at least stick with some of those patterns from the past that have been able to develop systems that have lasted over time, because this system is constantly changing. But we have methods like this, which we are studying right now, which is the harmonic patterns, that have stood the test of time. This pattern was developed earlier in the 90s, which I explained to you in episode 1 and 2 when we talk about the history and the logic of harmonic patterns. And currently, we are on episode 3. Yes, we are still on the ebook itself, which is available on our Telegram community. Link would be in the description. And you can get the ebook for free, where traders share their chart and analysis on, trading that can help you generally. So we are trying to build a digital community where traders can get access to charts and ideas for free. So that's what the Telegram community is about. You can check it out, get the ebook, and also you can get ebooks on Wyckoff, Elliott Wave, even smart money concepts, psychology, so many other ebooks which are available on Gumroad and also within the Telegram community. Now, when we talk about harmonic patterns, let's dive into what we have for today. Today's episode, I'm going to be showing you guys some of the traditional patterns of harmonic pattern, and I'm going to be showing you what makes them logical and their relationship with Fibonacci. And also, it's also something to bring to notice that Fibonacci ratios can also be used as strategies on their own based on just market structure. So I think that is something that I might teach you guys in the future, but the next mentorship I'm looking forward to is the neo support and resistance, which is popularly also known as the Malaysian support and resistance. But that will be around September, October. We will look into that. But what you should understand that the Fibonacci itself is what I'm trying to let you guys understand here, because it's not a system itself, it's not a concept. These are mathematical ratios that have appeared on so many places. I'm not talking about just the trading space. I'm talking about even the music, nature, so many places over time. And it's something that on its own blends with different concepts. Fibonacci has been used on ICT, it has been used on smart money, it has been used on harmonic patterns as we're seeing right now. It has also been used on support and resistance, so many concepts. That's to tell you that one of the reasons why this system, these Fibonacci ratios are significant is because it doesn't really blend, it doesn't really, sorry, stick to any single concept. It's a pattern of nature. It's not developed by anyone. The person who found this system, which the Fibonacci ratios, the word Fibonacci, the person just discovered it. Just like I'm talking about JForex, I'll say I can't say I created it. I can say I created most of the content within it, but the community itself, I found it. That's what I would say because it was existing before me. It's just something that came through me. Basically, I channeled it. And that is one of the stuff that this person did, because that's basically bringing people's awareness to something like this. It was already existing, but you just basically were the first person to become conscious of this particular stuff. So you became aware and you brought it to the awareness of civilization, which now is now being used by different intellectual individuals. So when we talk about something like that, we're saying the Fibonacci is a universal thing. And this is something that appears everywhere in nature, down to even God's creation, not the creations of men. Because when we say appear everywhere in nature, you might be thinking maybe I'm talking about in terms of building or in terms of art, which we know that we humans do. But I'm talking about even down to the structure of how the shell of a snail is being built. This also still makes sense with Fibonacci ratios. When we talk about the pattern on the back of a butterfly, like the artwork on the back of a butterfly, which we clearly know that nobody did that, no human being did that, it was done by nature itself, can also be interpreted using the Fibonacci ratios. The stars can be read using the Fibonacci ratios. The movement of the earth can be calculated using the Fibonacci ratios. So that's to tell you that this cannot be discovered by a human being. Like, sorry, it cannot be created by a human being. Like, a human being cannot create something that was existing before humans. You understand? But that doesn't mean a human can't discover it. You can be aware of it. You can be the first person to, have known things. That's to say, there are so many unknown right now in the universe that we humans have yet to be aware of. AI is recently coming into the picture. AI is not really a platform. That's why you have multiple platforms that use AI tools. It's a tool that can be enhanced into whichever digital system you want to, if you know how to. You see, so it's just something. It's a matter of being aware of it. So the Fibonacci ratio is something you can use if you know how to. You can put it into anything. You can put it into harmonic patterns, Wyckoff. You can put it into supply and demand, smart money concept. ICT, which is the optimum trading level, is still being used with Fibonacci. So this particular concept itself is something that can be used with support and resistance. And I think we'll discuss mainly into it in the future, if probably we're going to be having a mentorship program dedicated to using Fibonacci ratios, because yes, I do know how to use that particular um, system when it comes to trading, not when it comes to creating things of nature, when it comes to trading. So, but today we're going to be discussing how it's being used in harmonic patterns, and most of these patterns within harmonics that you hear names like bats, butterfly, you know, and it also makes sense why these patterns and names like this, because basically we do know that the Fibonacci ratio, like I just explained to you, is something that was used to design the bats and butterfly too, So it makes sense why most of these stuffs are called crab, the bullish crab pattern, the butterfly pattern, because it is mainly Fibonacci ratio. And yes, this system is also very, very accurate when it comes to forex trading. Just it's not that popular because people don't really understand it, and it has a lot of numbers. It has a lot of numbers. It's not really that understandable just with illusions and diagrams. You have to stick to numbers. So it's a calculated method, and nobody really likes math. So people don't really know that this is a very, very efficient system of trading. So first of all, when we talk about Fibonacci ratio itself, I think there was an episode, yes, a chapter. This is chapter 2, where we discussed deeply into Fibonacci ratios. And then I outlined the ratios which play a major role in identifying the system. And this is just market structure, where we identify the Fibonacci ratios on market structure. The particular video on smart money concept before this one, where we discussed about fundamental influence of analyzing using smart money concept. I talked about also, I actually practically used Fibonacci ratio on that particular class. And you can see how efficient it was identifying the key levels on the monthly. That is if you have watched that particular video. If you have not, you can check it out. It's titled Fundamental Influence, um, um, Top-Down Analysis with Fundamental Influence, which was released recently, about 3 to 4 days ago, when this particular video was being released. So they should be very close to each other when it comes to identifying them. And it's on a red background, which is the official theme for Smart Money Concept videos. So this is on a green background because it's harmonic patterns. Now, back to this. The Fibonacci ratios are major areas within key levels of a range that market retraces into before creating a new range. So on this range, we would have key levels on price action that market is likely to react from based on supply and demand. So Fibonacci ratios help you to identify those areas. On this range is where I'm drawing out these levels. So this is the range high, this is the range low. So you take the Fibonacci tool from the high to the low. I had to draw it to this point so the numbers could be showing outside of this point, because if I stopped it here, the numbers would be stuck here. So I had to draw it out. But this is the low where the Fibonacci ratio was drawn, not this one. If I had to measure this range, I would place the high over here and place the low over here. Then the numbers of this range would be displayed here. So this level, which is called the 61.8 Fibonacci level, it's a major key level, which is just above equilibrium. Equilibrium, when we talk about equilibrium, is saying premium and discount. As you all know, we do what? We sell within premium and then we buy within discount. So above 50% is moving from discount to premium. That is, if you're coming, retracing into a bullish range. That is, if this is a bullish range and this is a bearish range. So we'll be coming from discount into premium. And let me write that. Let me annotate that on the screen. So this is premium and this is discount. Okay, so we're retracing into premium. And the first equilibrium, the first level, the first significant level above the equilibrium level, okay, would be the 61.8 Fibonacci level. Now, in a very, very bearish market, that is on a high momentum market, since this is a bearish range, the market is likely to react from the 61 Fibonacci level because it has fulfilled all righteousness to be logical. Because the 81 Fibonacci level is one of the most 88, sorry, that is this, is one of the most significant and most premium level of them all. As you can see, 88 is basically saying we are about to fill this range 100%. And once we go above this, the high has been broken, except we have a manipulation in terms of smart money concept. And the price closes back below this high, then we call that what? A stop hunt. But if that is not happening, then the 88 Fibonacci level is where price is supposed to react from, on a retracement if this is not a break of structure. The 61 Fibonacci level is basically saying price still has a POI above, which means point of interest above, and this is creating an inducement that is likely to get cleared out, maybe if price is then breaking structure, that is now breaking this high, you see, to create a new higher high. That is if there's a break of structure. So most of the time when price is retracing, it's either reacting from the 61 Fibonacci level, leaving this zone blank, either to be used as liquidity to trap traders like this, then creating a new structure form like this. So most of the time, liquidity is always available in the market. But we also do see price actions where market do fill up to the 88 Fibonacci level. So that's to say, these are the two major key levels within the Fibonacci when it comes to retracements. Remember, we're talking about the Fibonacci retracement here. We have so many Fibonacci tools when it comes to trading that you can use. But for this particular video, I'm breaking down the retracement ratios for you. This is based on retracement, not just Fibonacci in general. So that's a different topic. And now when we talk about based on retracement here, we are saying key levels within the Fibonacci ratios that you should also be aware of to expect major reactions from would be the 61 Fibonacci level, which is mostly within premium on a downtrend and would be within discount on an uptrend because, you'll be flipping the Fibonacci too. And then we have the 88 Fibonacci level as well. This is between the ICT official OTE level, optimum trade entry, something like that. That's for ICT traders. And then we also have the 38.2 Fibonacci level as a very, very significant level as well. That is mostly where we have the breaker block level. Okay, that's to say if this was happening like this, 61, then you see something like this, and then price goes up to something like this, and then comes back down to something like this before going back up again. So if you pay attention to what I just drew here, price tested the 61, check, came back to test the 38, check, then went back up to test the 88, check, then returned back down to officially test the 50, check, because 50 was invalidated to test 61. The 50 was also invalidated again to test 38. Then 78 or 70 was not really that tested. That is 70 based on the ratios I identified here, but 78 is more relevant than 70. But this is the official ratios of the Fibonacci, not just my key levels. What you have on the diagram here is my own personal key levels, which I use on Fibonacci. And why I'm breaking down these levels for you is not just because I want to, okay? When we get to the aspect of the patterns themselves, you would have to be aware of how significant 61.8 Fibonacci level is, how significant 38.2, 38 Fibonacci level is, how significant the 38 Fibonacci level is as well, how significant the 88 is, and how structure basically mitigates all of them without just going in a straight line. That's what I'm trying to do here. And please don't mind the way I call the Fibonacci ratios, because I'm someone who is already very familiar with what I'm doing. Don't get me wrong. So I pronounce my own Fibonacci ratios based on percentage. As you can see here, that will be the 38.2, the 61.8, the 88.6. You see? So, but what I'm explaining to you here is based on the ratios themselves. So that will be 0.38, 0.61, and that's where the confusion is coming in. And then when you look at it from here as well, you would also see that they are also displayed in terms of percentage, not ratios. So if you've been watching and you're wondering, why am I pronouncing it wrongly? And then you're looking at the ratios. I'm pronouncing based on the percentage. Okay, that doesn't mean I don't know what I'm doing. Just pay attention to the knowledge itself. I'm just doing this for clarity, okay? Now, back to what I was trying to explain. As you pay attention to what's going on with just the diagram, I'm trying to give you a meaning here, because if you do watch the video I posted before this, where I made a practical example of using the Fibonacci ratios, you would also notice that I identified the key level before actually using the Fibonacci ratio. That was to make a point that I am already very, very aware of how to use this stuff out of experience. I've been using this for a very, very long time. So I can basically just pick out the key levels because I have actually observed the Fibonacci ratio for the past 5 years of trading. I've been using this system for a very, 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 very long time. I'm not saying using harmonic patterns, but I am very used to systems that are not based on concepts like the Fibonacci ratio, like astrology and all of that stuff. This might not sound like it's interesting to trading, but at the same time, if you do your own research, you make your own statistics, and you learn from your own experience as well, you would be amazed. That's all I can say. You will be amazed. So I have been amazed, and I'm currently doing this out of my experience after being amazed, not when I'm amazed. You are the one who is learning now. You have not yet been amazed. You have not done this practically. I'm the one who have practiced this, and I'm giving you examples of how you yourself can practice this so you too can be amazed. Being amazed is not the point. It's after being amazed so you can make money with it. Okay, so don't just use it once, get amazed, and then leave it. Use it till, over and over and over and over again, just like I have done. And don't admire my success now. Remember, I've been doing this for the past 5 years. If you're just starting this, then you have to wait for time to pass as well while you practice this. So you too can identify key levels accurately, even without using the Fibonacci tools. Okay, so don't just think because I'm being able to show you this very simple on um videos, mean you yourself can do them very simple in just one day. This video was made after 5 years of practice. There's a big difference with you just watching it and trying to practice it. Okay, now when we look at the key levels we just identified, we have the 78 Fibonacci level still vacant, right? But the Fibonacci ratio is trying to say price would move in this form, which you can see structure is already forming based on these ratios I have identified. Then after testing the 113 Fibonacci ratio, which is basically saying a swing break of structure has occurred, we still have the 71 left, right, within the range. And then if you pay attention to this internal structure, what would that be? A break of structure, which now means that would be the official breaker block level for this retracement to form before heading back up to test the 141 Fibonacci level, still also creating the internal structure, which I can also guarantee you, if we do place a Fibonacci ratio from here to here, you will find out that a key level within this range is being tested in alignment with the 71.8 from the previous range. And remember, this alignment is basically from this range, not even looking at what level this would be. Let me use a different color on that. So what level this would be on this major range here. That is how powerful the Fibonacci ratio is. I'm just showing you how powerful the Fibonacci ratio can put together market structure. Okay, this is basically what the content you have within the ebook. All right, so I just broke down this little diagram for you in terms of market structure, so you too can understand what I'm trying to, explain with just figures on this ebook. So this is where the Fibonacci is displayed in percentage, and this is an image of me using the Fibonacci tool on chart. So from this point to this point is a high. So the first Fibonacci, which is this, was identified from this point to this point, and price retraced into the 88 Fibonacci level, which is the complete level of this range, which, as you can see, we had another block resting there. And then the Fibonacci 2 was placed from this high to this low, which is this here. Okay, and the price retraced into the 61 Fibonacci level, leaving available the 88 Fibonacci level, which happens to be the extreme point of this range, and also a demand zone, having the 61 as an inducement, like I explained to you earlier. And then that is basically how Fibonacci can also help you identify lots of things happening. If you look at in terms of how price action fills up, you can see price went up, mitigated this level, which is the 61. Remember, this is inverted since it's an uptrend. This I explained to you is a downtrend, so this is inverted. So the 61 and everything above is below here. Y is above here. So remember how to place the tools so you can get accurate results. And especially when you want to use them on harmonic patterns, you have to make sure you know how to place the tools so you don't get misinformation. As you can see here, price test this level, went up, tested this level, returned back to test this level, which this has been tested, test this level, went back up again, test a new level, came back down, test this, before coming back down officially to test this new level. That's basically explaining how this level was completely tested before this level was created. So basically, Fibonacci level is basically how this whole thing works. Fibonacci ratios is basically how this whole thing works. And if the same ratios are the same designs that the butterfly pattern works, the same design that the snail pattern works, and so many other things as well, that's to tell you how powerful these ratios are. Okay, so it is everywhere. It's also in music, and I just show you how logical it can be on trading. So you can do your own research into Fibonacci ratios and then see how you can also use them in whatever aspect of business you can find yourself or whatever you find yourself in. Remember, this episode is basically more about Fibonacci ratios and the patterns. So I can show you how these patterns work. But at the same time, you can't know that if you don't know how to identify the Fibonacci ratio. So this is where we have the identification of it. And on the next episode, which will be episode 4, I'll be on the chat to show you a live example of how this can be done and where you can find those harmonic patterns on your trading view. Or maybe we can have an episode on your MT4 if recommended from the community. But for now, we are on episode 3, and this is the ebook where we break down how this system works. The ebook is available for free. Link will be in the description so you can study it in your own time as you go through these visual breakdowns of how you can use harmonic patterns. Now we're moving over to chapter 3, where we discuss about the core harmonic patterns. When I say core, I mean the traditional patterns, the patterns which have already existed. So as you all have seen from the display of what we have as Fibonacci ratio, this is the second part of the video now. Okay, we're officially about to look into the patterns, no longer Fibonacci ratios. So we're done with the first part. We're moving over to the second part. Now, when it comes to traditional patterns, I'm talking about patterns that have been identified by analysts like you and I from the past, and other analysts have used these same exact patterns. It doesn't mean that these harmonic patterns are limited to just these traditional patterns. So you can have a system where you use smart money concepts and then harmonic patterns is in line with it, but basically the ratios are shifted. Maybe where you were supposed to expect an 88 Fibonacci retracement, you're thinking it's likely going to be on a 61 because of the demand zone or maybe the liquidity or what you already know from smart money concept. You can still use that. Okay, these patterns are just traditional. They are just patterns that have been practiced over time. Yours can still work. Okay, so the Gitli pattern, whichever way I'm pronouncing it, because it's named after somebody, and I have my native tongue, and if you notice from the language and from the assets, I'm Nigerian from Benue State. I'm just using English. So this, I think, is Gitli, Abi Gatli. Yes, is named after the pioneer of these harmonic patterns. That is the guy who created these harmonic patterns using um, these ratios. That is, I think, in the early 90s. These first patterns were made basically just mainly after him. Okay, this was what he knew. He never knew about the bat, the butterfly, and the rest of them. Those were later developed over time. Same way I'm teaching you right now. People started studying his work, and then they started knowing other patterns that could form. So they started becoming aware. Just like how people use the Fibonacci ratio after it was discovered by I think it was an Italian, and then they started becoming aware of how it appears on every other aspect too. That was how the harmonic pattern itself was also being used. So the other patterns developed over time, but this is the oldest traditional pattern that is being used. And then if you observe this pattern itself, you can see that from X to A is a range. That's to say, this is trying to identify, this is where price goes bullish from. Okay, so this would be like this. All right, then we would have this as a break of structure. Break of structure. Now, I'm also going to be using terms related to smart money concept for my people because I know most of you are already very, very familiar with smart money concept. And this is a new pattern for you. So for us to be able to understand it better, I'm going to try and make you see what you would averagely see on smart money concepts. Okay, so you would see this as a demand zone or a POI, and you will see this as an inducement, right? This was the previous break of structure. So this is the same thing. All patterns, all concepts are all based on the same thing if you know how they work. Now, why you can also see this? Why you can also see this? I'm also going to be showing you how the Fibonacci ratio comes into the picture. Because you can say, okay, if this is just ordinary smart money concept and just one aspect of smart money concept before the other patterns were put together, because this is older than smart money concept. So you have to understand that this aspect and this aspect that makes this a smart money pattern were later discovered after this. That's why I say you don't have to stick to just the traditional patterns. Okay, this is trading and it's moving. So new price action comes out every day. The algorithm keeps upgrading. You have to also upgrade your mentality. So if you're a traditional harmonic pattern, be open to learn smart money concepts. And if you're a smart money concept trader, be open to learn harmonic patterns. That's what we're trying to say. Okay. So while you're also understanding this and you're being amazed by the fact that smart money concept can fit into this weird looking structure of harmonic pattern, you have to also understand that from this point to this point is a single range, right? We have this high, this low, this high, sorry, this low, this high, okay? And this would be the internal structure. Let me use a different color. Yeah, this would be the internal structure of this external range. This is using smart money terms to break down what's going on. And what this pattern is basically trying to say is that the previous internal low, which is the retracement of this range, happened to be liquidity, right? And the price made a fake out, which if you noticed from the short videos I create, and we have the team who puts together a very, very fantastic short video that breaks down smart money concept and other patterns. If you don't know, you can check them out. We have reels, short reels that are very, very educational. Even me, I learn from them. That all I have to do is bring down the informations and the other members of the community create a very beautiful reel that you can learn from. Now, a recent one I created, I talked about smart money trap, where I gave them information of how internal structure relates to smart money trap. Okay, so that internal low, which is this low over here, as this is a bearish range, let's say this was a 4-hour low and external was a daily structure. Okay, so this 4-hour low, which happened to be a weak low since this is an internal structure, was the inducement to this swing structure, right? Now, looking at that and remembering what I just told you guys earlier about Fibonacci ratios, what I just taught you guys about Fibonacci ratios, and looking at the official level of where wave B within the harmonic pattern mitigates. That's to say what this line means. Let me take everything out. Please visualize this. If you can screenshot it, do, so you can study it later when you're reading the ebook. This is wave X to A, right? That's the first leg. This is the second leg, which is the internal structure, the third leg, and the fourth leg. Okay? So that is basically what creates the bullish pattern. Okay? Now, looking at this, we say wave A to B is a retracement to this 61 Fibonacci level of wave X to wave A. Now, isn't that logical looking at this as an internal structure? Like I said earlier, using Fibonacci ratios, I told you that 61.8 is the first official formal key level below what? 50%, which is the equilibrium of this range. Discount, premium. So if 61.8, Fibonacci level is the first key level below 50 and is the official leg for wave A to B. Doesn't that make this logical? I'm just saying, doesn't that make this pattern logical? And if that makes it logical, and based on smart money, we view this as an inducement, doesn't that mean wave C to D being an official retracement into 78 of 88 Fibonacci level of wave A, X to A as the official start of the main swing, being the last area of interest within the first wave? If this was a swing structure and anything below this will be an invalidation, doesn't that make this pattern even more logical? Because this pattern puts together internal structure and external structure as one. This point is the internal structure. This point is the external structure, right? So on this aspect, wave B to C is a 38 Fibonacci retracement. A test of the 38 Fibonacci retracement level of wave A to B. This wave from B to C is a test of the 38 Fibonacci level of wave A to B. Remember, wave A to B is testing the 61.8 Fibonacci level of the first range, right? Now, the internal structure was then created in the process of this, right? Now, since the Fibonacci ratio will be flipped on your own practical time after watching this video, because you have to practice it, you now have to now test these things on the chart, which we will do in the next episode, but I need you to do it yourself so you can also better understand what we're trying to teach here. Remember, I told you this particular pattern is very, very calculated. It's one of the reasons why it's not that popular. But as you can see, it's very, very logical and can be very, very effective if you use it with the right information. Okay. Now, looking at the next range, since we now understand how this and this was created, looking at the next range, which is B to C, is now the 38 Fibonacci retracement level of wave A to B. Remember what I told you guys about the key levels of Fibonacci? Fibonacci itself is a key level of market structure. All Fibonacci levels are key levels of market structure. But then within the key levels of market structure, which is the Fibonacci ratios, we now have key levels. So there's a shell inside the shell, just like how you have the shell of a snail. There's a smaller one, then there's a bigger one, then it keeps going in circles and circles, and that's how this stuff works too. So within the retracement of the first range, we have that test of the 38 Fibonacci level, which is price now going back into the first bearish leg and mitigating the first official level of this range. And now at the same time, why we have the 88 Fibonacci level here is because if you flip the Fibonacci to the other side, looking at it from this level, same way we have this testing the 61.8 Fibonacci of this level. If you flip it, this will be showing you something like the 61 Fibonacci level. If you flip it, the 88, that was an error, the 88 Fibonacci level of this range, right? So, but if you pay attention to just this range, that will be the 38. So it's kind of like showing you both perspectives based on whichever range you are actually drawing your Fibonacci on. So when you start looking at it from this perspective, you now understand why you have the 160 something Fibonacci level, because that is looking at the end of this range. Remember, I just broke down how this range forms to the upside. Now I'm breaking down how the C to D forms, because the C to D calculates after this range has been invalidated. So everything below this is 1 point, 1 point. But that doesn't mean this has been invalidated, right? And that's why this is still on 0 points. But once we start having 1 point, you know that that's below just the retracement. So we can say the retracement was drawn around this level. And then below this was 1 point, 1 point, 1 point. So the 1 point of this ended up being the 7.88 Fibonacci level of this. So this guy never got invalidated. But this range is calculating below this range. This figures here, y is on 1 point, is calculating below this range. And this is how this pattern is broken down using Fibonacci ratios. I broke it down for you using smart money concept, which is easier, right? You can agree with me that understanding it with smart money concept is easier, just looking at this as internal low, liquidity, demand zone, But at the same time, let me draw that so you can also see it. So we say liquidity, right? Liquidity. Area of interest, market structure, right? So this would be our area of interest. And price generated liquidity, giving us the bullish side, liquidity on the bearish side, and then previous break of structure, new break of structure. Entry point, take profit. This is using smart money concept. But previously, what I just did just now was using Fibonacci ratio. And that is how you have these patterns. And that's why you see the breakdown here. I had to zoom in so you can see the breakdown for itself before you look at what we have on the write-up. Okay, now look at it now and rewatch the video and see how much better you can understand what I'm trying to say. Because this is very, very interesting. This is one of the most interesting and logical method out there to use in trading Forex. But it's not well understood, so people don't really know how to use it. But I just broke it down for you in a way that you can understand it better. So wave C to D extends to 0.78% of A to X, which is, A to X or X to A. So this particular wave, this extends to this. That is giving us this figure here, like I explained earlier. But the 1 point and all of that you see is talking about the B to C and how C to D extends below the range of B to C. That's why you see it's drawn like this. Okay, and this is drawn like this. And then while this is happening, I'm breaking this down to the most simplest way possible. So you can then use your own reasoning to then notice how this is formed. Okay, because there's a breakdown too. X to A, A to B is the retracement of the 61 level. Remember, you're flipping the Fibonacci down, and then you do the same thing, 38, that is B to C, retracing into A to B. You see? B to C retracing into the 31 or the 88 of A to B. That is based on the level of which you are placing your Fibonacci ratio, like I explained earlier. And then C to D extends into 71.8 of X to E. That is this. While at the same time giving you the figure, looking at it from this perspective. And that is how this pattern works. Now, let me also show you on smart money concept how that looks. This would be clearing out liquidity. Okay. So this would be the previous break of structure, new break of structure, internal structure retracement, range high, range low. Pardon my drawing. Range low. And this will be the creation of liquidity here. If you wonder why or how is this a creation of liquidity based on smart money concept, you can see the fake change of character here. And then a lot of traders will be interested in buying from here. And then you can see the double bottom, which is also a retail liquidity pattern, a very old pattern too. So, but now it doesn't work that much and it's being used for liquidity. And logically, you can see how it's being used for liquidity. So this is logical. This based on smart money concept. Smart money can also still explain this. So yes, smart money do work, But smart money doesn't give you this Fibonacci calculation. So as you can see, harmonic patterns are not really a thing. It's just a pattern based on Fibonacci ratios. That is exactly what this ebook has been trying to say. That is what the ebook actually says. That is what the ebook, it says Fibonacci ratios are the basic fundamental structure of harmonic patterns. Okay? Fibonacci ratios is the basic fundamental structure of harmonic patterns. So once you're able to understand how Fibonacci ratios work, you can see it's basically just lines understanding Fibonacci ratios. Do you understand? So this is the relationship between Fibonacci ratios and harmonic patterns. Fibonacci ratios are the basic fundamental structure of harmonic patterns. Why Fibonacci ratios are the key levels of market structure. The key levels of Fibonacci ratios goes to the 61.8, the 88, the 77, and every other key level that you can see, which is the key levels that form this pattern. So the harmonic patterns are using the key levels of Fibonacci ratios to identify important levels within market structure. So it's a vice versa system, how it helps you to understand market structure. Okay, so I'm going to be stopping here for now so we don't make it too complex for you to understand. On the next episode, I will show you practical examples of how to apply this on the chart, which should be released within the coming week after this is being released. Thank you, and I will see you on the next episode. Bye.